You open your banking app and the number looks normal. Your 401k is still there. The mortgage payment cleared. So why does your financial life feel one bad month away from becoming a full-time emergency? That is the uncomfortable setup heading toward 2027. The biggest financial risks facing American households are not necessarily exotic. They are not all hidden in some complicated Wall Street product. Most of them are sitting in plain sight, disguised as normal monthly payments, normal retirement assumptions, and normal levels of debt. And that is what makes them dangerous. A financial risk becomes serious when three things happen at once. You do not see it clearly, you cannot exit it quickly, and several other households are exposed to the same pressure. That is how a personal problem becomes a national problem. It is also how a manageable expense becomes a retirement delaying event. So here are 7 financial risks many Americans may not be ready for in 27. What could make each one worse? And what would make the warning less severe? Risk number 7 is high-interest debt that never gets a chance to shrink. Credit cards are useful because they are convenient, widely accepted, and sometimes loaded with rewards. They also create one of the most expensive forms of household debt when the balance is carried from month to month. Annual percentage rate, or APR, is the yearly cost of borrowing expressed as a percentage. When your card charges an APR above 20%, a balance can grow much faster than most safe investments can reasonably earn. That creates a brutal mismatch. Your savings might earn a few percent. Your debt may cost 5 times as much. Federal Reserve Bank of New York data have shown total American credit card balances above $1 trillion, while delinquency has become a growing concern among some borrowers. That does not mean every household is in crisis. It means the weak spots are becoming easier to see. The most vulnerable person is not necessarily the person with the biggest balance. It is the person whose balance is rising while income is flat, whose minimum payment is becoming a permanent subscription, and whose credit line is being used for groceries, utilities, or medical bills. Watch your balance trend, your interest charges, and a percentage of your payment going toward principal. Principal is the amount you actually borrowed. If most of your payment disappears into interest, you are running uphill on a treadmill owned by a bank. This warning becomes less serious if wages rise faster than expenses, interest rates fall, and households pay balances down aggressively. But the question you should ask is simple. If your income stopped for 8 weeks, would your credit card become your emergency fund? Risk number 6 is an emergency fund that exists only on paper. Many households say they have savings, but the important question is whether that money is liquid. Liquidity is your ability to access money quickly without selling at a major loss or paying a penalty. Home equity is not the same as cash. A retirement account is not the same as cash. A credit limit is definitely not cash, no matter how politely the app labels it as available spending power. Federal Reserve surveys have repeatedly found that a meaningful share of adults would struggle to cover a modest emergency expense using cash or its equivalent. That matters because emergencies do not arrive one at a time. The car repair shows up the same week as the dental bill. The furnace fails after the insurance premium increases. The layoff arrives 3 months after you financed a new vehicle. A realistic emergency fund is not based on what sounds responsible in a personal finance article. It is based on your actual fixed costs, job stability, insurance deductibles, family obligations, and access to credit. A dual-income household with stable government jobs may need a different cash buffer than a commission-based salesperson with 2 children and a high-deductible health plan. Personal circumstances matter. Watch your essential monthly expenses, not your total lifestyle spending. Then calculate how many months you could cover without new debt. The warning is less severe when the labor market is strong, your household has multiple income sources, and your insurance coverage is broad. But ask yourself this: is your emergency fund designed for an emergency, or designed to make you feel responsible while most of your money remains difficult to reach? Risk number 5 is retirement money exposed to the wrong kind of timing. Long-term investing works because markets have historically rewarded patience. But retirement creates a specific problem called sequence of returns risk. Sequence of returns risk means that poor market performance early in retirement can damage a portfolio more than the same decline later in retirement. The order of returns matters because you are withdrawing money while the portfolio is down. Imagine 2 retirees with identical average returns over 20 years. One suffers a major decline in the first 2 years and keeps withdrawing for living expenses. The other suffers the same decline near the end. Their outcomes can be dramatically different because the first retiree is forced to sell more shares at lower prices. This is not an argument to abandon stocks. Stocks can remain essential for growth, especially when retirement may last decades. It is an argument against assuming that an average return arrives in a smooth, friendly line. John Bogle spent his career emphasizing low costs, broad diversification, and long-term discipline. Those principles still matter, but diversification is not simply owning 5 funds that all fall for the same reason. You need to understand what actually drives each asset. Watch your stock allocation, your expected withdrawal rate, your cash needs for the next few years, and the tax consequences of selling. Also watch concentration. If one employer's stock, one technology sector, or one property dominates your net worth, your retirement may be less diversified than the statement suggests. The warning becomes less severe if markets are strong, withdrawals are flexible, spending can be reduced temporarily, and reliable income covers basic expenses. But before 2027, ask, if your portfolio fell 25% during your first year of retirement, what would you sell? And what would you refuse to sell? Risk number 4 is healthcare inflation that quietly rewrites your retirement budget. Medical costs are not just another line item. They are one of the few expenses that can rise while your ability to work falls. Premiums, deductibles, copays, prescription costs, dental care, vision care, and long-term services can all hit different parts of the household budget. Medicare is critical, but Medicare does not make every retirement healthcare expense disappear. A deductible is the amount you may have to pay before insurance begins covering certain services. A high deductible plan can reduce monthly premiums, but it also means you need more cash available when care is actually needed. The risk is especially serious for people retiring before Medicare eligibility, households managing chronic conditions, and families supporting aging parents. It is also serious for workers who assume their employer coverage will remain unchanged. Watch your annual out-of-pocket maximum, prescription coverage, provider network, and whether your preferred doctors remain in-network. In-network means the provider has negotiated rates with your insurer. Going outside that network can become very expensive very quickly. The warning becomes less severe when healthcare inflation slows, policy changes reduce costs, and your household has strong coverage plus dedicated savings. Health savings accounts can help eligible households because they offer tax advantages, but they are not magic. The value depends on your plan, your health, and your ability to contribute. Ask yourself, does your retirement number include healthcare as a rising cost, or did you treat it like a fixed utility bill? Risk number 3 is the growing cost of simply owning a home. A fixed-rate mortgage can protect you from rising interest rates on the loan itself. It does not freeze the rest of homeownership. Property taxes can rise. Insurance premiums can rise. Association fees can rise. Maintenance does not care whether the Federal Reserve cuts rates. Roofs, plumbing, air conditioning systems, and foundations have their own monetary policy, and it is usually hostile. In some parts of the country, homeowners are also facing higher insurance costs, reduced coverage, or difficulty finding affordable policies that can affect monthly cash flow and resale value. This is why the phrase, "my mortgage is only $800," can be misleading. Your true housing cost includes principal, interest, taxes, insurance, maintenance, utilities, and transaction costs. It may also include the opportunity cost of having a large amount of money trapped in one property. Opportunity cost is what you give up by choosing one use of your money instead of another. The most vulnerable homeowners are often those who bought near the top of their budget, assumed refinancing would solve the payment later, or underestimated repair and insurance costs. A house can be a valuable long-term asset. It can also become a cash flow problem while still looking impressive on a net worth spreadsheet. Watch local inventory, insurance renewal notices, property tax assessments, major repair needs, and the percentage of your take-home pay consumed by housing. This warning becomes less severe if income rises, insurance markets stabilize, and local demand remains strong. But ask, could you comfortably carry your home if taxes, insurance, and maintenance increase by 15%, even though your mortgage rate stayed exactly the same? Risk number 2 is depending too heavily on benefits that may change. Social Security is not expected to vanish. That is an important distinction, but the program's trustees have warned for years that, without legislative changes, trust fund reserves will eventually be depleted, and incoming revenue would cover only part of scheduled benefits. Recent projections have moved the expected depletion date into the early 2030s for the retirement trust fund. That is close enough to matter for anyone planning to retire in the next decade. The danger is not that every check suddenly becomes zero. The danger is building a retirement plan that requires every projected dollar to arrive on schedule while leaving no margin for policy changes, taxation, inflation, or personal expenses. Social Security was designed as a foundation, not necessarily as the entire house, yet many retirees rely on it for a large share of their income. Watch congressional action, official trustee reports, your estimated benefits, your claiming age, and whether your retirement budget can absorb a reduction. Claiming age matters because starting benefits earlier generally produces a smaller monthly payment, while delaying can increase the monthly amount up to certain limits. The warning becomes less severe if lawmakers act early through some combination of taxes, benefit changes, or other reforms. Historically, the United States has changed Social Security before. The 1983 reforms are a reminder that political delay can eventually produce action. But your question should be, if your future benefit were lower than the estimate on your statement, what expense would you cut first? And risk number one is the combination risk. This is the one most financial plans miss. You can survive one bad event. You can handle a market decline if your job is secure. You can handle a layoff if your emergency fund is strong. You can handle a medical bill if your debt is low. You can handle higher home insurance if your monthly budget has room. The real danger appears when several risks arrive together. Hyman Minsky, an economist known for studying financial instability, argued that long periods of stability can encourage people to take more risk because the system appears safer than it really is. In household finance, the same psychology shows up when you assume your job will continue. Markets will recover quickly, credit will remain available, and your major expenses will behave. Then the cycle turns. A recession weakens income. A market decline cuts your portfolio. Banks tighten credit. A home repair arrives. Insurance renews at a higher price. Suddenly, assets exist, but cash does not. That is the difference between net worth and resilience. Net worth measures what you own minus what you owe. Resilience measures how long your financial life can keep functioning when reality becomes inconvenient. The Great Depression, the 2008 financial crisis, and the COVID-era market shock were very different events. But they shared one lesson. Financial systems often look strongest right before households discover how many assumptions were connected. So watch the connections. How much of your income depends on one employer or one industry? How much of your net worth depends on one market? How much of your monthly spending is fixed? How quickly can you raise cash without taking a major loss? How many financial problems would begin if one paycheck disappeared? This warning becomes less severe if inflation cools, employment remains strong, markets rise, credit stays available, and household balance sheets improve. That is entirely possible. A risk is not a prediction. It is a condition that deserves preparation. You do not need to panic before 2027. You need to remove the illusion that normal means safe. Start by knowing your true monthly obligations. Understand your interest rates. Review your insurance. Stress test your retirement withdrawals. Treat healthcare as a growing expense. Read your Social Security estimate with a margin of safety. And make sure your emergency fund is actually available in an emergency. The goal is not to predict the next crisis. The goal is to make sure the next crisis does not get to make every decision for you. Because when you open your banking app in 2027, the most important number may not be your account balance. It may be the number of months your financial life can keep running when something stops going according to plan. This content is for education only and is not personalized financial, tax, legal, or investment advice.